We have new numbers today that show how many Americans filed jobless claims last month. It was 218, less than was expected. Let's go to Scott Wren on this, senior global market strategist at Wells Fargo Investment Institute. Thanks for joining us today.
Hi, Merle.
So we knew the labor market was softening. Why do you think we aren't seeing a corresponding rise in these claims?
You know, I think usually, over the last, I don't know how many cycles, you could really count on initial jobless claims to be a good leading indicator on the U.S. employment market, but it really hasn't worked this time. And I think, really, if you look at it, companies, they're not hiring, but they're not firing either. And so it's an odd kind of a labor market, but it's one where, and you saw it in the surprise upside GDP number, the surprise upside to personal consumption is, if Americans have jobs and they have money in their pocket, they're going to go out and spend it. So I think the labor market is hanging in here, but we certainly expect it to weaken a little bit as we look ahead.
Yeah, you mentioned the GDP number, 3.8%, and you see more growth ahead for the U.S. So what are you basing it on?
Well, I think that's it. When we came into this year, we expected to see weaker CapEx than what we've seen, and we thought that the unemployment rate would rise quicker and that consumer spending would see more headwinds. And really, we haven't seen either of those yet. And so I think for us, the U.S. economy, 70% of it basically is consumer spending that's held in. And then we've had some nice upside surprises. You talk to these companies in the first and second quarter, their earnings, just beat the consensus big time, and they all confirmed and maybe even increased the amount of CapEx they're going to spend. Anything that's directed towards AI, CapEx-wise, in almost every case, it's been increased. So I think that's what's going on, and that's why GDP is better. And, we've got a 2% number out there for this year, and we've got 2.4% for next year. But, I don't think we're going to see a lot of 3.8% quarters as we look ahead over the next 4 or 5 quarters. But, growth's going to be modest. And the labor market's going to weaken a little bit, but I think we'll still see reasonable consumer spending.
You mentioned the amount that's being invested into AI. That being said, there's been a pullback from some of the large tech. What's your read on that? And are you still favoring tech moving forward?
Yeah, there's several sectors that we like. We like technology. We like financials, we like industrials, we like utilities. And most of those have some tie into AI. And I think after this gigantic run we've seen in these mega caps, it makes a little sense. The numbers we saw today made some people think, hey, maybe the Fed isn't going to be as anxious to cut rates as we look ahead. I think, the October meeting, the December meeting, those are probably pretty well locked in, but it's next year. And then, of course, the bond yield jumped up naturally. You have better growth and a little bit higher inflation, and the yield on the 10-year is going to go up. And tech stocks are very sensitive to those rising interest rates because you're trying to discount those cash flows that are way out. And so I think it makes a little sense that people took a little money off the table today. We'd love to see a 10% pullback because I think it'd be an opportunity to step in and buy some stocks. So if we get it, I think we'll be taking a little money out of bonds, putting a little bit of money towards stocks. We've got a 7,500 target for the S&P by the end of next year. So, we're optimistic on this market and hoping for a pullback.
You mentioned exactly that. You're looking perhaps to put some money in on a pullback. You think there's more volatility ahead?
Yeah, I certainly hope so. We tried to be patient coming into the year. When we had the pullback in late March and early April, we tried to take advantage of that, moved a little money out of bonds, moved it towards stocks. We had already been overweight large caps. We're overweight mid caps as well. We're underweight small caps. But I do think there's going to be more volatility. I think there's a chance here. The volatility would maybe be caused, something that would cause, let's say, a 10% pullback. Let's say there's a little bit of an inflation scare where the market's nervous about inflation, what that might mean for the Federal Reserve in terms of interest rate cuts. There could very well be a growth scare. Now, saying that after a 3.8% quarter, I don't know, but I think, you could get a little bit of a growth scare. You could get a little bit of an inflation scare. This tariff situation with China, and then, of course, Mexico and Canada as well. Are all those resolved? I don't think so. So I think there's a few things out there that might make the market nervous. We've come a long way. Stocks aren't cheap. So, we are hoping for a pullback as an opportunity. That's the way we're looking at it.
Let me ask you about another geopolitical event. We had Donald Trump now moving more strongly to the side of Ukraine, saying it can regain territory lost to Russia. Are you seeing any of this playing out in the markets? And what's your theory on if it will sort of moving forward?
Well, that's clearly a bad situation. Russia, Ukraine, lots of lives lost. I think the way that it affects the market, though, is through the price of oil. And so, if we see some disruption to the supply of oil and oil goes up, let's say it would trade up into the, upper 70s into the 80s, something like that. I think the market's going to have a negative reaction to that. In the meantime, there's certainly been some optimism on military spending, defense spending in Europe, some defense spending here in the States. So, from that perspective, it's been a bit of a positive. But I think for the way it really affects the market in the near to intermediate term is what happens to the price of oil because of sanctions on Russian oil, anything energy related. That's where it's going to affect the market first.
Scott Wren, good to have you, sir. Thanks for joining us. Scott's a senior global market strategist, Wells Fargo Investment Institute.